Hello everyone, John Hardy here with the video FX update for this February 25th of Friday, about 20 minutes before the New York close, getting to you way later than I hoped. And today we have the bounce. Hey, it's happy days everyone. Crude oil is all the way back down to the level it was at, 2 days ago. Funny how yesterday's spike suddenly creates the idea that the spike stopped, and therefore we should all celebrate this the fact that the spike stopped, even though the absolute levels of where we were just 2 days ago. Regardless, everyone taking it as good news. Pro-risk currencies doing well, equities doing well. And the question is, of course, how long does the bounce last? And we'll see. Still driven, I think, in the very short term by oil prices. Again, commodity currencies doing quite well. We have the dollar CAD at a new low below 98 today. Aussie poking up towards that 102 area at its highest levels today. Sterling doing very, very poorly on the downward revision in the GDP, showing a deeper contraction in Q4 than the first estimate, and on continued ugly survey numbers in terms of consumer confidence, and that's brought those central bank expectations, I think justifiably. The market was getting a bit too excited about that recently. Way lower in this differential. Saw the sterling lower, way lower against the dollar earlier. It's bounced a bit since the dollar, and actually it's managed to make a comeback against the euro and the dollar later in the day. But still, overall, that was negative news, certainly in the reactions if we look at expectations for the Bank of England. Euro finally taking a breather here. It tried the top of the range overnight. One of those situations where a new high in Asia turned out to be a low-quality one. That's sometimes the case, or quite often the case, I think, that when you're starting to break towards new highs, it's not something you should bite on, or it's a low-quality break when it happens in the Asian session on Eurodollar. And we can't say that it's anything more than a sign of caution ahead of the Irish election. But the euro was weaker today, and we're seeing a bit of a ease off on the ECB expectations there as well. Interesting to note this. We were reading this article by David Rosenberg of Gluskin Sheff, who points out that everyone's saying, well, Saudi Arabia has the spare capacity to make up for the shortfall in Libyan crude oil production cessation. But we have to keep in mind that crude oil is not crude oil. There's sweetness and there's the heaviness of the grade. And Libyan oil is ideal for low sulfur diesel fuel production because it is very light, has very light gravity, and very low sulfur content, therefore very sweet. The Saudi stuff is inferior for that type of production, and it would take 3 barrels of Saudi oil for the actual end use of what this oil is being used for, that is low sulfur diesel fuel. It takes 3 barrels of the Saudi stuff to make 1 of the Libyan stuff. So it's not, apples are not, oil is not oil, apples are not apples, however we want to say that. Getting my metaphors mixed up. But anyway, that's an important thing to keep in mind. I think a bit of sanity check on the oil prices as well, as we did come off very high momentum yesterday, but it's kind of stabilized and we're back up, actually a buck higher on the West Texas grade from where we closed yesterday. And this is aside from the uncertainty of any contagion, etc. This is purely if Libyan oil goes offline. Also out today, we had a strong U.S. Michigan confidence number. This confirms the strong conference board number for this month, and confirms the stronger employment picture. Whether equity markets are in play here, it's hard to determine. I would also say at some point higher gasoline prices are going to start to affect consumer prices negatively. If we hit $4 a gallon of gasoline, those consumer confidence levels are going to have a hard time heading any higher unless the economy is somehow defying gravity in such an instance. Themes. Well, we seem to have a sigh of relief today, but even before all of this developed with Egypt and Libya, I think we were already getting a bit white knuckle crazy on the risk appetite moves, on the whole pumping up of the balloon on the Fed's POMO and the QE2, etc., etc. So the relief bounce here. We've been looking for the establishment of a sideways trading market even before all this happened. So I think there's plenty to worry about in this market, plenty to be uncertain about, even if for the short term, even in the best case scenario on the geopolitical front. Looking elsewhere, look at New Zealand and this terrible earthquake that happened. They're estimating now it's going to cost 10 billion New Zealand dollars possibly in damages. That's 7 point something percent of yearly GDP. That's a big problem, and we're actually starting to see rate cuts priced in for the RBNZ, and yet Kiwi dollar is higher. It shows you the truly pathetic state of the dollar here, and also how much the market, for whatever reason, seems to want to trade that pair on a risk appetite basis. But that's incredible. Keep that in mind going forward. That's a very low expectation for the RBNZ now. And they may follow up with that. This is a very serious situation down there, and they actually may cut rates at some point in the near future. But this being possibly a one-off type thing also related to that earthquake. So it's a bit of an isolated situation. Again, we hatched the idea of yesterday that the market is trying to play this whole situation as lose-lose for the dollar. Oil prices go down and risk goes up. That's bad for the dollar because the Fed has no credibility on the upswing in policy rates that's supposedly underway. Actually, we're kind of seeing the opposite over the last few days, but the general picture being that central bank expectations have been higher if we look versus a couple months ago anyway. And also losing on the opposite, on the flip scenario, that is if crude oil prices go up because of reserve diversification by petrocurrency powers, and because the U.S. is so vulnerable on its insane the levels of its petroleum needs. So that's the market still trying to play that theme. That theme weakened a little bit today with the euro weakness, sterling weakness, but not enough to certainly to administer any critical blow just yet. And of course, the euro at a crossroads here, finally nodding its head at the fact that the Irish elections are taking place this weekend. The results of those not available, unfortunately, until tomorrow when they start the official counting. Looking ahead, of course, we have to keep an eye on ad hoc geopolitical events. If an Algeria goes offline for a while, this is bad too. It also aggravates, from what I understand, doing a brief amount of research, the situation with crude oil because of the grade of Algerian crude also being somewhat similar to Libya's, and that would make a mess of the diesel fuel situation in Europe. Irish election results tomorrow, obviously, and next week, very busy week, very, very, very busy week. It's the classically busy week in terms of the U.S. data with the ISMs out and the employment report on Friday. By the way, on that one, it wouldn't be a surprise to see a very high payrolls number after the heavily seasonally affected numbers last time around. But big picture, and this is important to note because we've been saying March 3rd on the Humphrey Hawkins testimony, which is true, but that's the second day of the testimony. That's when he testifies to the Senate. The first day, when it's clear what he's going to say in his testimony, the first question and answer session will be on Tuesday. Sorry, not Tuesday, Wednesday, the 2nd. So be aware of that. I will be traveling on the 3rd, but fortunately I will be there on the 2nd to see what Mr. Bernanke has to say and how the market is reacting to both his testimony and, again, the key idea being, is the Congress getting on the same page on what the Fed is doing to the dollar, to the U.S. economy, and are they ready to put up an obstruction to this crazy Federal Reserve and what it's doing? We suspect QE3 is out of the question, but this will be a very key indicator on whether that is the case. The market, I don't think, is pricing that in. And that would, of course, finally, possibly, if that's true, and if this happens during next week's testimony and Q&A sessions, that would be finally something that could throw the greenback a rope, the dollar finally finding some shred of credibility. If not, if the Congress is continuing to have burying its head in the sand and we never get the needed austerity, the needed austerity and the needed resistance to the Fed, then of course the risk is that the dollar heads lower. Here we go. Charts, euro dollar, top of the range here. We tested it overnight. Bit of a back off here so far, just a consolidation. If we look at the weekly, kind of interesting. Of course, this trend line. If we do a dollar index, it's the flip side, and it's actually with the dollar yen so weak. We have that testing up closer to this level on the dollar index, and that's threatening higher. Notice how these sort of bearish candlesticks, that just didn't pan out. So that's unfortunate there for those looking to trade off of that the candlesticks. Cable, we had it a lot lower earlier. The interest rate spreads justifying this recent move. We had a very sharp move higher in the short sterlings. So emphasizing that we're still in the range here, and we need to get back above that 162.50 and close above there to believe that the upside is back in play. On the downside, this 160 area, obviously very key, a big psychological area. Look at this. We had a whole batch of days where 160 couldn't really hold on the close. Finally did, and that was the key support. So the 160, I think, is the trigger level. We range trade between 160, well, we'll call it 163 and 160, and look for a close on either side to get a better pointer on what's going on. Euro sterling backing off despite the more negative data or more negative reaction to what's going on in the UK. I think this sort of retreat is basically the caution ahead of the Irish election results, and same thing for Euro Swiss. And Euro yen looking very, very ugly here. Look at this ugly close on the week. Everything pointing now to the downside there if any kind of negative news flow out of Europe. If we take this to the weekly, look where we turned around. This is Ichimoku levels are often very interesting. 55-day moving average. Well, we had this resistance zone here at 114, and this move into the Ichimoku cloud did not hold. So that emphasizes the range for now. Dollar yen, this trend line looking pretty interesting. We didn't quite draw this right. We did have a test through that trend line, but basically we are testing this trend line once again. And if Fed interest rate expectations continue to come off, and especially if we do that, plus go back into a risk-averse situation, all the yen crosses could be under some serious pressure if yields continue lower, and again, risk aversion is on the way south. Looking at the remaining charts, let's start with dollar Canada, heading to a new low. We've played this theme before. We've gone to new low, retraced, new low, retraced, etc., etc. Let's see if it gets any momentum off of this. I would suspect it only would if both crude oil heads higher and we see let's say a full-scale test of the old highs in equities. Aussie dollar looking pretty peppy. Nothing to suggest this should be the case on the interest rate spread front, but copper making a very strong bid higher, and this is really beginning to test close to that ascending triangle. Again, assuming that this is a false top, ascending trial formation, but let's close above there and see if it's able to get any more momentum. I have a hard time believing risk appetite is going to support Aussie beyond, let's say, the next week or so at the very max, but we've been wrong on that before, so let's see what happens. Kiwi, again, the amazing thing being that it's not heading lower, with RBNZ outright cuts now being priced in up to 10 bips, so the year forward, and still not able to get any downside off of that on the Kiwi dollar. Crude oil, as we pointed out, this is super bearish, a classic climactic reversal formation here, but there's no follow through just yet. $112 crude is $112 crude. Very worrisome if we stay up here and don't get any confirmation of that and a stronger sell-off back towards $100 or below. And that's the equity balance you see right there. Finally, I think there were a couple of charts I wanted to show you here. Yes, this is just the STIRs, this being the short sterling March 2012 3-month STIR, and look at the reaction here to the UK data flow today, and we're good 25 or so ticks off of the low here. So pretty strong reversal in the Bank of England expectations after they recently went so high. Much less so in for the ECB, but still headed a bit lower relative to the extremes the last couple of days. And on the same token, at the long end of the curve, we have pretty low yields with the ones maintaining a fairly decent bid, and that's what's helping the yen crosses lower here. Sterling yen being lower, and euro yen closing pretty interesting close to this week. That will do it for today. You can follow me on Twitter for intraday comments and various links to articles I send out. And everyone have a great weekend out there. Watch those Irish election results, and let's see how we open the week. What I think will be a very pivotal week, possibly for the dollar next week, one way or another. Again, great weekend, and we'll catch you next week. Take care out there.